Assalamu alaikum, crypto traders. Welcome back to another action-packed lecture in our crypto trading series. If you're new here, smash that subscribe button and hit the bell so you never miss a strategy, analysis, or alpha drop. Today is lecture 08, and we're diving into one of the most requested topics, understanding chart patterns in crypto trading. Whether you're trading Bitcoin, Ethereum, Solana, or altcoins, this class will turn you into a chart pattern pro. No time to waste. Let's get started. Chart patterns are visual formations on price charts that help traders predict future market movements. Rooted in technical analysis, these patterns emerge from historical price data, reflecting market psychology and the balance between supply and demand. In crypto trading, where volatility is high, understanding these patterns is crucial for informed decision-making. Support and resistance. Support is a price level where buying interest surges, preventing further decline. Resistance is where selling pressure increases, halting upward movement. Markets move in trends: uptrends, higher highs, lows; downtrends, lower highs, lows, or sideways. Volume indicates the strength behind price movements. High volume during breakouts confirms pattern validity. The head and shoulders pattern is a bearish reversal formation that typically emerges after an uptrend, signaling a potential trend reversal. The structure includes a left shoulder, a head, a right shoulder, and a neckline. The pattern is confirmed when the price breaks below the neckline, ideally with increased trading volume. The price target is calculated as the vertical distance from the head's peak to the neckline, projected downward from the breakout point. If the head peaks at 60 and the neckline is at 45, the target is 30. Typically, volume diminishes during the formation of the right shoulder and spikes during the neckline breakdown. The inverse head and shoulders is the bullish counterpart, forming after a downtrend and indicating a potential upward reversal. The structure includes a left shoulder, a head, a right shoulder, and a neckline. The pattern is validated when the price breaks above the neckline, preferably with a surge in volume. The price target is the vertical distance from the head's trough to the neckline, projected upward from the breakout. If the head troughs at 25 and the neckline is at 35, the target is 45. Key considerations include the neckline slope, pullbacks, and false signals. The double top occurs after an extended uptrend, forming two distinct peaks at approximately the same level, separated by a moderate pullback. The pattern is confirmed when the price breaks below the neckline. The price target is measured by subtracting the pattern's height from the breakdown point. For example, peaks at 100 and neckline at 80 imply a target of 60. Volume is typically higher on the first peak, weaker on the second, signaling fading bullish momentum. The double bottom develops after a prolonged downtrend, creating two troughs at a similar level, separated by a rally. The pattern is validated when the price breaks above the neckline. The price target is calculated by adding the pattern's height to the breakout point. For example, troughs at 50 and neckline at 70 imply a target of 90. Key considerations include the time frame and the need for confirmation. The triple top occurs after an uptrend characterized by three peaks at approximately the same price level. The pattern is confirmed when the price breaks below the neckline. The price target is calculated by subtracting the distance from the peaks to the neckline from the breakout point. The triple bottom develops after a downtrend, with three troughs at a similar support level. The pattern is confirmed when the price breaks above the neckline. The price target is measured by adding the neckline to trough distance to the breakout point. Key distinctions include the strength of support resistance and the differences in peak-trough formations. The rising wedge forms during an uptrend with two converging ascending trend lines. A bearish signal is triggered when the price breaks below the lower trend line. The falling wedge forms during a downtrend with two converging descending trend lines. A bullish signal occurs when the price breaks above the upper trend line. The rounding top occurs after an uptrend, forming an inverted U shape. The neckline acts as a support level, and a breakdown below this confirms the reversal. The rounding bottom develops after a downtrend, creating a U shape. The neckline acts as a resistance level, and a breakout above this confirms the reversal. Additional notes include the importance of time frame and confirmation to avoid false signals. These patterns work in crypto trading just as they do in traditional markets. However, crypto markets are highly volatile, so it's best to confirm patterns with volume, RSI, MACD, and other indicators before making a trade. Don't forget to join us on WhatsApp community and like our Facebook page. Links are in the description. If you like this video, hit like and subscribe to my channel for more informative videos.